A very good afternoon. Let's get into the markets. Asian markets were up today with Japanese equities hitting a record high. This as tech stocks saw gains on Wall Street on upbeat earnings, while there's a growing expectation of lower interest rates in the biggest economy in the world to help mitigate the potential inflationary fallout of higher US tariffs. The Nikkei share average advanced by 0.65%. The Hang Seng Index closed up 0.7%, while the Shanghai Composite Index rose by 0.16%. US stocks put in a decent showing in yesterday's session with the tech-heavy Nasdaq leading the charge. This was propelled by Apple's announcement that it would invest $100 billion in the United States, expanding its manufacturing capacity there, heeding the call of President Donald Trump. That saw the Apple share price jump by over 5%, with McDonald's also rising by about 3% after reporting better than expected earnings. While the markets ended positive on the day, the economic effects of higher US tariffs have yet, of course, to be measured. The Dow Jones Industrial Average rose by 0.2%. The S&P 500 advanced by 0.73%, while the Nasdaq Composite Index jumped 1.21%. Looking at the local indicators, we see that the all-share index is up over that 100,000 index point level. It's up 0.6%. On the currency front, we see that the rand is trading at 17.71 against the US dollar, 20.68 vis-a-vis the euro, and 23.68 against the British pound. So we see some rand strength there. Gold is trading at $3,377 an ounce, platinum at $1,327 an ounce, while Brent crude oil is trading at $67.19 a barrel. All right, let's get into conversation now with Mohammed Wagli. He's a portfolio manager at Sasfin Wealth. Thank you so much for joining us, Mohammed. So I wanted to zone right into the Apple story. They've committed to invest $100 billion in the United States. And I remember some years ago, its CEO, Tim Cook, talking about how China had become instrumental in its success because of the technical prowess that they'd managed to secure in the workers there. So this latest announcement sounds to me like a very expensive grudge purchase. Your observations?
Oh, absolutely. I imagine the cheap labor cost didn't hurt too much as well. So I think, look, just a bit of context on this. There's been quite a bit of tension between Apple and the Trump administration since Mr. Trump got into power. And, sort of big thing for him was that, these iPhones and iPads, which are like, a manifestation of sort of American exceptionalism, are not produced in America. And that's really what he wants, So Apple were kind of stuck between a rock and a hard place in the sense that, they could either bite the tariffs, or they could invest a little bit into US infrastructure and get a bit of a pardon in that respect. And it does look like they've taken the path of least resistance. Now, practically speaking, it's very unlikely that, these phones are going to be produced completely in America, even in the medium term. So it's not as if that they're going to start producing the phones there. I think there's a few more components that are going to be produced there. They're investing a lot into sort of the supply channels, into some manufacturing capacity there in the US. And I think there was a specific glass component that's being produced in Kentucky, and Tim Cook made quite a show of building that and then handing it over to Mr. Trump. But I think from a market perspective, we've obviously quite liked this because it represents a dissipation in that tension that had been building up between Apple and the US. So it's a bit of a step in the right direction. Practically, I'm not sure sort of how many new iPhones are going to be produced in the US. It's very unlikely that that's going to happen anytime soon. But yeah, ultimately the company was stuck between a rock and a hard place, and they took the path of least resistance.
Indeed. So we've had this chat before, but now there are very serious concerns about stagflation for the US economy, with an anticipation of further rate cuts sooner rather than later. And that directly relates, of course, to the higher US tariff policy being effected on most of its trading partners. What are some of the risks that you anticipate, and how do you see those translating into the markets and the way that you guys go about your business in allocating funds?
Okay, well, yeah, so I think it's fair enough. I think what has sort of precipitated the stagflation narrative again is that we are seeing a little bit of softness from a labor market perspective. We've been seeing some stagflationary pressures on the services side of the US economy as well. And so when you combine that with, the sort of relatively softer employment numbers, it looks like it adds another layer of incentive or impetus for the Federal Reserve to cut rates and do so soon to support a somewhat deteriorating labor market. That being said, I think what investors, the market generally needs to consider is that this data doesn't necessarily take into account the fact that President Trump and his administration has laid off is probably not the right word, but deported 1.5 million people. In addition to that, the impact of AI, at least on sort of the lower level jobs, hasn't really, been noted enough. But I think what is worrying investors is that, we're seeing a somewhat deterioration here before these tariffs have even set in, so in terms of the quantum of impact is actually very difficult to say for the time being, because on one hand we don't know how much the tariffs have affected the economy negatively, and then on the other hand we don't know how much money has come into the US because of these tariffs as well, so it's something we'll probably get a bit of feedback on within the next month or so. But for the time being, the issue is to what extent are these tariffs going to impact the market, and the truth is we just don't know yet.
Yeah. So here at home, the local bourse closed up nicely over 100,000 index points yesterday and remains firmly above that level as we speak. Can this level be sustainably maintained and be a base from which the markets can operate from? And where do you see value? Because, of course, it means that our market is a bit more expensive than it was a few months ago.
Oh, that's absolutely fair enough. But I think to answer the question, we kind of need to take a bit of a dive into what's actually been driving performance here. So if I look at the all share, which is the proxy for the JSE, we've seen a near 20% gain in the year 2025. Now, if I isolate that to the 40 biggest companies, the top 40, that gain goes to about 23%. And then if I look sort of a little bit further, and split that up, the resource 10 index is really what's been driving performance. That's up about 70-odd%. If I look at the financials, we're seeing muted performance, much of a muchness really. If I look at property, more or less the same. If I look at retail, it's really not moved. So what's been driving performance is those resources, and specifically gold and platinum. So the question is, are those drivers of gold and platinum still there? Can they continue to sort of grow? And, for the time being, the uncertainty is definitely there, so from that perspective, we could see a little bit more growth. But the broader question is, what about the rest of the market? Where do we see catalysts for growth in South Africa specific shares? And the reality of that situation is that it's difficult to see those catalysts, so when you ask me where do we see sort of a bit of value, from a valuation perspective, if I just look at the numbers, pretty much all of the retail sector looks good. But before I see sort of a catalyst that, could indicate a bit of growth, I'm unlikely to, advocate that sort of sector with too much conviction. The reality is, probably got to be playing in the same spaces that we have been, that has seen the growth that we have seen in the JSE. So maybe those resources, but that too, it's relatively low conviction.
All right. Thank you so much, Mohammed, for your insights. As always, that was Mohammed Wagli. He's a portfolio manager at SABC.